Hello, Steve Lentz here with Discover Options. Welcome to the Prepared Mind. This is for Friday, August 5th, getting ready for Monday, August 8th. We have two reports for you today. The S&P 500 Condor Butterfly Timing Report for those of you that do range trading with condors and butters. We'll look at some timing mechanisms there and see if there's an edge. Also, just to give you a general feel for what the direction of the market should be, we have the Directional Likelihood Report. We're going to go over the methodologies for both reports. Hope you'll find this interesting. Presented material is for educational purposes only and should not be construed as personalized financial advice. To subscribe, we'd love to have you subscribe. Click on the button below. Also, before we get to the reports, we have if you click on the link on the top right, we have a book, Simple Steps to Options Trading Success, an ebook. You could get it from OptionView by clicking on that, and it's co-authored by myself and Jim Graham. I think you'll find it very useful. The two reports, the Condor and Butterfly timing report, we'll start with that one right there. And we'll go over the reason why you should look at this report, the methodology behind it, and then what the current condition is, and any edge level there is for doing condors and butters right now. Why should you look at this report? Well, let's say you're back on December 31st of last year. Market started trading in a range, and if you looked at our report, you would have seen that at this time there was a negative edge for doing condors and butters, minus 4.2%. Now what does that mean? That meant that there was a higher than usual likelihood that the market was going to be more volatile than what was implied by the option prices at the time. That's what we're trying to do, is figure out the likelihood that butters and condors are going to succeed given the market condition. And in this case, at that time, it was minus 4.2. Look what happened. Of course, we can cherry pick examples and all that, and this is a drastic one from the beginning of 2016, but I think you get the point. This is something maybe you should take a look at. Here's the current condition finishing up on Friday. Market had an inside day there on Wednesday. Thursday was an up day with a narrow range, and then Friday was a strong uprange day, upswing day as well. So two straight upswing days, higher highs and higher lows, and then the close was higher on Friday than on Thursday. We're above the 50-day moving average, and in terms of stochastics, the 15-3 stochastic is right around 70, so we're between 50 and 90, and it is above its 3-day simple moving average. So the market is trending up, a couple upswing days. The stochastic is getting into the higher range now. It's above its moving average, and so if we were to go back in time to Jan of 2000 and look, we'd want to look at this same market condition and ask ourselves this question: is this current condition, what I just described, a good one for selling option premium through range trading, butters and condors? That's what our quest is to find out, and here's how we do it. We observe how much the market actually moves from a given close. Okay, then we look at the market move that was predicted by the option prices, the implied volatility. What was the market? How much of a move was being predicted by those prices, option prices? We then compare the two, the actual to what was being implied, and then we label the bars favorable or unfavorable for selling premium through range trading. All right, and so here's just an example. Here's how we look at the 21-day move from any given close. We have the indicator on the bottom, but here's how we do it. Here's an example of a close at 2076. If we go forward 21 bars, 30 calendar days, 21 trading bars, how much did the market move? Well, it went down quite a bit right there, down to 2026. That works out to about a 2.4% move. And you could see that's what the little measurement is there down underneath the chart. Now, what market move was being implied by the option prices at that time? When you look at it, the VIX was implying a move of 4.4%. That's a higher number than the actual. Okay, so that was a good close to then sell premium. If the premium was implying a 4.4% move, yet what actually took place was a 2.4, that works out to be a good bar, a favorable bar for selling premium, in hindsight, of course. So we're going to paint that bar blue. along with several other bars that worked out well that way. And the bars that are unfavorable are the ones where the volatility of the market was higher. The market moved more than what the option prices were implying. Those are the red bars in hindsight. Of course, on the far right, we have black bars because those are just undecided yet. We don't know if those are going to turn out to be red or blue. We have to wait for 21 days to go by for each of those bars to be labeled blue or red in hindsight, right? Okay, so we got favorable or unfavorable. So here's how we do this. Historically, we ask ourselves, what percentage of all the bars going back are favorable? Okay, and as you'll see, it works out to around 64%. Of the bars that match our current condition, what percentage of those were historically favorable for selling premium? Okay, of the bars that match our condition, and there was around 165 of them going back to January of 2000. Of those 165 bars, what percentage of those were favorable? And any difference represents an edge. So when we go back and look at just how many of all 4,000 bars going back, it's about 4,150 bars going back to Jan of 2000. 64.5% are blue, favorable for selling premium neutrally. 35.5% were unfavorable, where the market was very choppy and kind of would have given you a little few headaches for trading butters and condors. Okay, so here we have our condition. You can see it's occurred in a number of times. So we have 64.5% is the baseline. Now let's go to our particular condition we have now. Of the bars that match our current condition, what percentage of those were historically favorable? And when you look, 68.2% were favorable. That works out to about an edge of 3.7%. Okay, so right now it's better than flipping a coin. At least historically, you have the wind at your sails a little bit. I've seen this number much higher, of course, but 3.7 puts you, on the correct side of it's a little bit better than flipping a coin. A lot of people, of course, put on butters and condors at certain times of the week, certain times of the month, consistently in a seasonal basis. But here, you could see that at least now, as of Friday, going in as of at the close, we have a favorable condition, just a little bit. Okay, so let's go on to the other report, the directional likelihood report. First, let me make sure you understand we have a great website, discoveroptions.com. Go check it out because we have some one-on-one mentoring courses for you to look at. Covered calls, puts and collars. Some of you more advanced traders go to the equity track or the futures track if you're into futures. But we have just a wonderful set of 14 classes for you to take to get yourself up to an advanced level. We have professional traders that'll help you get up to an advanced level of trading butters and condors, understanding the market condition, liquidity, order entry, all that stuff. So check us out. We'd love to have you aboard, and I know you'll end up being an expert options trader with our curriculum we have and our cutting edge research as you're seeing here today. Okay, let's go to the directional likelihood report using statistical volatility. This is the market likelihood report using statistical volatility, and I'm going to show you exactly what we mean by that. Of course, we have our current condition. And the question here is that since Jan of 2000, how often has this same condition occurred? 165, we already know that. But where did the market go? Did it go up, down, or wobble in the middle? Okay, we're not dealing with butters and condors here. I just want us to get a feel for where the market is likely to go. Okay, and so here's how we do this. We first try and understand the historical distribution of price. Then we're going to understand the price distribution after our condition, and then we'll look at any edge that could exist. All right, so here's how we do the historical distribution of price. Okay, we measure by observing how often price touches the 1 standard deviation volatility bands that are placed from each bar's closing price. I do this in 3 different formats, 5, 10, and 15 days out. These bands are 1 standard deviation from the close. I use historical statistical volatility of 20-day historical vol, and then it's log normally distributed. Here's just a quick example. 10-day, 1 standard deviation bands from the close. And here's the question on the table, folks. Is the market going to go up and hit that upper band in the next 10 days, or the lower band, or wobble in the middle and hit neither? Okay, so let's just see what happened here. Oops, went up and hit the top one. So for that particular close, we're going to record in our database that it went up and hit the upper band. Okay, now look at the next close right here. The bands are set a standard deviation up, standard deviation down. The question is, for this close, did it go up and hit the upper, the lower, or wobble in the middle? Okay, in this particular case, if you look close, it tried to come down and hit that lower band, but it failed to, just barely. So in this case, it hit neither band, and that's what goes in the database there. So what we do is, from every close, we record how often price struck the upper and the lower 5, 10, and 15-day bands. And we get a baseline distribution of all the closes going back in time, and here's what it looks like. Okay, going back to Jan of 2000 through August 5th, 2016, price hit the upper band roughly 29% of the time, the upper 10-day band 23% of the time, 15 band 23, the lower 5-day band about 30% of the time, almost 30, and then 32% of the time. So that is the baseline distribution over 4,162 occurrences since Jan of 2000. Now, let's take a look at our specific market condition, and then we're going to see how often it, from those particular points, okay, we're going to understand the distribution after our current market condition has developed in the past. So here you have several instances where the same exact market occurrence. Here we are today, or as of Friday. This same kind of market condition existed several times in the last few months, you can see. So what we're going to do is look at the distribution as of the close. Then we're going to look at the distribution if price the next day goes above the high of that bar. So if Monday it goes above the high of Friday, we want to know what the distribution is in those particular cases. And what if price goes down below the low of Friday? What's the distribution then? That way you get a feel for the distribution of price going into Monday's open, depending on where price goes from there. And I think that might be worthwhile and hopefully helpful for you for your trading. So here we go. All right. As of the close on Friday, okay, here's the historical distribution. Look at this, 165 occurrences. All right, and of those 165, it hit the upper band only almost about 11% of the time, or roughly 18.5% less often. Look at that. It hit the upper 5-day band way less often, the upper 10-day band far less often, 15-day band far less often, the lower bands far less often, a little bit less often, a little bit less often. In general, price seems to be wobbling in the middle between the bands a lot more often than than what historically it has. Okay, so that's where we are as of just the close on Friday. Now, what if it goes above the high on Friday? If it goes above Friday's high, that happened 105 times in the past. Of those 105, price went up and hit the upper band, but not even 9% of the time. It's over a 20% difference. It failed to hit the upper and lower bands in a dramatic fashion. So we're seeing here that the market really is, if history plays out, we are in for some low market volatility. If history plays out, that's what. Now, it doesn't mean it's true. I mean, the 1 time in 10 that it could go up and hit, or 1 time in 20, or 1 time in 10, 2 times in 10, it can go up and hit, or down and hit these other bands and get more volatile. But I think we can see between around 8 to 9 times out of 10 that our condition has occurred, the market has been way less volatile than normal. Okay, that's kind of what we're looking at here. Now, if it goes down and if it goes below the low here on Monday, if it goes below Friday's low on Monday, well, then it's actually hit a few of the bands more often. by just a little bit, and the other 4, it definitely hit just a little bit less often. So if it goes down below the low of Friday, we're in for some market volatility that's greater than what it would be if it went above the high on Friday. That's what the story is that this is telling you. Now, I like to do these bands using another method, and I like to use the VIX, but I like to skew adjust the VIX so that the upper volatility is a lower number than what the downward volatility is, so that the upside bands are a little closer to the close than the downside bands. Now, the VIX is higher than statistical volatility generally, so the bands are going to be farther away than the statistical volatility bands. The VIX bands are farther away, and they're skewed where the upside bands are closer to the close than the downside bands. So using this methodology, you can see here that the upper bands are hit roughly 15 to 20% of the time instead of 23 to 30. And when the bands are set this way, you still have a story where the bands are getting hit less often, in this case 5 out of the 6 times. 5 out of the 6 bands are getting hit less often. If it goes above the high, all 6 bands get hit less often. And if it goes below the low, then 4 of the 6 bands are getting hit slightly more often. So telling the same story, that if it goes below the Friday's low, we're in for some normal market volatility, or if not a little bit more. If it goes above Friday's high, look out for some low market volatility, and it would favor the range traders probably, okay? Okay, so that's the story that tells. Here's a market idea, a trading idea, hedged bull put spread. To do this, though, we need to look at the VIX, and we need to look at the skew adjusted VIX. Here's the VIX. If you skew adjust it using the SIBO skew value that's published every day, the downside volatility is at 13.1. The upside volatility is predicted at 9.6. So looking at that 13.1, we're going to grab that number, and we're going to run to option view. And in option view, we're going to plug that 13.1 in right up here. And when we do that, it sets the 1 standard deviation level here, and we'll a little bit less than 30 calendar days here. But the idea here is to do a credit spread out here. We'll do a 5-lot 20-point spread, and we're going to take some of that credit and purchase a hedge right here, a bear put spread, to hedge it so that if the market goes down and threatens our credit spread, at least this hedge here will pay us and give us some good return, and if it fails to reach our strike. But when you analyze this, look at the pretty picture this paints. It's a wonderful picture here. If the market goes up, no matter how far it goes up, we're going to make 5% there. If the market does go down, our hedge kicks in to the point where at expiration we can make upwards of 16%. And if it does hit our short strike out here, we'll lose roughly maybe a little more than 1 times what we're trying to make in the case that it expires out here on the downside. So a great picture. If you look at the price chart and we look at the profit and loss area there, the green, just a nice wide area of making money. That's what we like to see. Folks, thanks for joining us. I'm Steve Lentz with Discover Options. There's our website. Go check us out. We'd love to hear from you and give us a shot at mentoring you, taking you to the next level. Thanks a lot. Take care. Bye-bye.